Let's talk about something every investor thinks about at some point. You're looking at a stock that's on fire, just soaring, but your gut and your research is telling you it's about to take a nosedive. Today, we're going to break down the put option, a powerful financial tool designed for exactly that moment.
So let's start with that exact situation. You've done your homework, you've analyzed the market, and you are absolutely convinced a certain stock is way overvalued. The big question is, what can you actually do about it? How do you turn that belief into a potential profit?
Okay, here's our game plan. We'll kick things off with the core problem investors face, then we'll really dig into what a put option is. After that, we're going to walk through a real-world case study using Nvidia, run the numbers, and finally, weigh the all-important risk versus reward.
So first up, the investor's dilemma. It's a simple but tough challenge. What do you do when you have a bearish outlook? That strong belief that a stock's price is headed for a fall.
Let's make this really concrete. Just imagine you're looking at a high flyer like Nvidia. I mean, it's had an incredible run, right? But your analysis is telling you that sometime in the next year or so, a pretty big drop is coming. That's the exact problem we're trying to solve here. So, how do you solve it? Well, let's introduce the specific tool designed for this very situation. It's called the put option. So, what in the world is a put option? At its heart, it's a contract. It gives you the right to sell a stock at a set price by a certain date. Now, the magic words here are right, but not the obligation. You aren't forced to do anything. You're basically buying the choice to sell at a high price, hoping the actual market price falls way below it.
A great way to think about this is like buying insurance on the stock's value. You pay a small fee, called a premium, for protection. But here's the cool twist. We're not just trying to protect ourselves from a loss. We're actually trying to use this insurance to make money from the price drop itself.
Okay, every put option boils down to 3 core pieces you have to know. First, the strike price. That's the price you lock in. Second, the premium. That's what you pay to get the contract. And third, the expiration date. That's your deadline. Your entire theory has to play out before that clock runs out.
All right. Theory is great, but let's see how this thing actually works in the real world. We're going to use a solid example with Nvidia straight from our source material.
Here are the numbers for our case study. So we're buying a put option on Nvidia that expires way out in March 2026. We pick a strike price of $160, and the cost, the premium, to buy this contract is $22 for each share. Remember these numbers, because we're about to put them to work.
And now for the part everybody wants to see, the math. Using the numbers we just laid out, how do we figure out our potential profit or, our potential loss? Let's walk through it together.
Let's start with the best case scenario. Your prediction was dead on. By the time the expiration date rolls around, Nvidia's stock has crashed all the way down to $100 a share. So what's your profit look like?
The calculation is actually pretty simple, just 3 steps. First, you take that strike price, $160, which is the price you have the right to sell at, then you subtract the real market price of $100. That gives you a gross profit of $60 per share. But hold on, we're not done yet. We have to factor in what we paid for it.
And there it is. After you subtract that $22 premium, your net profit is $38 a share. Just think about that for a second. You more than doubled your initial investment, all because you were right about the stock going down.
But hey, trading is never just about the upside, right? What happens if you're wrong? We have to flip the coin and take a hard look at the risk involved with this strategy.
This is such a critical question. What if Nvidia doesn't fall? What if at that expiration date in March 2026, the stock is trading at $160 or even higher? You've got to understand your potential loss just as well as your potential gain. This breaks it all down beautifully. You've got 2 simple outcomes. If Nvidia's price is below your $160 strike price, your option has value. You get to sell at a higher price than the market, and boom, you make a profit. But if the price is above $160, well, your option is worthless. Why would you use your right to sell at $160 when you could just sell it for more on the market? You wouldn't. The option just expires.
And this is probably the most important part of managing your risk when you're buying puts. Your maximum loss is set in stone from day one. The absolute most you can ever lose is the $22 premium you paid. That's it. Your risk is defined, no matter how high the stock might go.
So let's just recap the big takeaways here. You buy a put option when you're bearish, when you think a stock is going to fall. If you're right, your profit potential can be huge, and maybe most importantly, your maximum loss is capped. You know exactly what it is the moment you make the trade.
And that really leaves us with one final thought. We've seen that a put option is a clear-cut tool. The risk is defined, the potential reward is clear, the strategy itself is pretty straightforward. The really hard part, the real question this all comes down to is, can you predict the future? Is your forecast for the market the right one?